Good morning all and welcome to this morning's video. So I have the same pair on watch this morning, which is Sugar USD. A big thank you before I forget to TradingView for featuring my last video that I made yesterday morning. Much appreciated, and welcome aboard any new followers that this may have resulted in. It's a pleasure to have you on board, and I hope I can continue to provide you and indeed TradingView with as much value as possible. And of course, the members of our Falcon community, where I also post this video. But without further ado, I'm going to break down Sugar USD. Of course, if you watch my videos regularly, if you watched that featured video, you will know what I'm looking for and why I'm looking for it. But for those that don't, and just as a refresher and to keep myself in the loop of good habits, by breaking down pairs in the repetitive manner that I do, so that it's ingrained in my memory. That's how I've ingrained all these patterns that we look for in my mind, is literally just by doing the same thing over and over again. Across the board, the market is some of the messiest price action I've ever seen. But the thing to remember, this is where people get bored, okay? This is where people lose a lot of money. This is where people get bored and jump into trades unnecessarily. And what I try to remind myself is, when we're seeing price action like we're seeing at the minute, which is really awful, to be honest, price is building volume for impulsive moves, okay? So the longer this happens, the more impulsive the moves out of it once it does finally break, okay? And I always think of it as, when the market's doing this is when we need to be patient, okay? I think of it like a massive brawl going on, okay? And everybody getting killed. And then what we need to do as traders is wait for the brawl to finish. And when all the bodies are dead on the ground, to use an expression, we just step over the bodies, okay? And get to the other side. That's my little analogy that I like to use. But while the market is finding its feet, the only thing really that stands out to me is Sugar USD, which actually looks a little bit further away from being ready than it did yesterday. But once again, if the market is building volume, then when it does provide an entry, if indeed it does, then it's likely to be more impulsive because of that volume that has been built in those supposedly quiet, in quotation marks, quiet times. Okay. So Sugar USD weekly chart. So I was looking at this because, as I said to you yesterday, the things that stand out to me straight away is that we have this high here and we have a near miss to it here. Okay. We also had this high here. So there was a possibility that either one of these could have been an area of value. And usually the clue is the near miss to them. Okay. So we near missed more so to this one. But in the grand scheme of things, if we just, in terms of from here to here, or this area here, this was a near miss to both of these areas relative to that move up. Okay. So the next thing I'm looking at is, okay, well, what has price done? Price has completely smashed through this high here. Why did it smash through there? Because they both look attractive. We had a sharp move up there followed by a sharp move down, and we had a volume. So volume was triggered here and volume was built there. Okay. So why was this one more attractive? Well, price is naturally always gravitating, if they're close together, to the more valuable price. People that are making money in this game are treating trading like a business. So therefore, if they're looking to sell, for example, they're looking for the more attractive area of value. So if they're close together, it will usually find its way to the more attractive one. Okay. There was also other clues. The fact that this sell-off, when it got to this low, it stalled there and correctively broke through it. Okay. It didn't completely smash through. If it did, then it would be more likely that price, when it found its way up to here, would respond from this area. But look how it broke the previous low. Okay. When volume was built here, we had a very aggressive sell-off, which did smash through a previous low, and it didn't just smash through excuse me, it didn't just smash through any previous low, it smashed through a very sharp low, okay, suggesting that there must have been a lot of volume here, but for it to be able to break through a low where there was probably a lot of volume. Okay, so to break through a low where there's a lot of volume, you must have generated a lot of volume for that to actually happen, to break it impulsively. Okay, Let's get all this off the chart so that we can actually make sense of what's going on. So I'm not surprised when we get back to this area that we gravitated. I'm not surprised that we ignored this area and gravitated back towards the more attractive area of value for those reasons given. And the clue that we were going to gravitate towards that area is that we had when we were down here is that I said we had this reversal structure. Okay, so we had this. I'm just drawing this crudely, but just to show you the sections. Okay, so we have the first drive, second drive, third drive, and so we have the 1, 2, 3, and on the higher time frames, we usually break below the lows if we're going to rally to the upside, and this second low just tapped it. Okay, so when there's such a standout area of liquidity like that, usually we will break it before moving to the upside rather than just tapping into it like that. And the clue as well is when we moved up, we had a correction which was wider, much wider than the impulse up which had preceded it. And normally when that happens, that is just the middle section within a structure like that, where we have the first drive, second drive, third drive, which then taps into an area of volume, which was there, where volume was built and where there was a big sell-off. Okay, and then we move down, break the lows, and then move to the upside. So the patterns that we look for, this is a term I haven't used for a while. They are fractal. Okay, so if you think of a kaleidoscope where you've got patterns within patterns, that's kind of what we see on the market. And Sugar USD seems to provide very, very clear examples of that. The other clue, this is something I'm noticing on the fly, but if we take this here, so I'm looking at this impulse correction continuation there. Okay, so if we measure that impulse, usually the leg out is of a similar length, and you can see there that that's 95%, if not more. So we have the impulse correction continuation. So I'm not surprised, therefore, that we didn't stop at that area of value that I was just talking about, because that would have been about, if we just measure, so I'm measuring there. Okay, that high there would have only been about 70% of the length of this move up for that impulse correction continuation, whereas that one is about 88% of the move. Okay, so it's fulfilled almost 90% of that move. So there's lots of little clues, and then we tap into that area. But this is where people, so when price is down here, people are thinking, okay, we'll sell this. One thing I'm doing is I'm looking at, so when an area of value is an area of value, usually the last leg has momentum. If we're going to sell off from there, that's usually the buyers getting out of their positions, and we see the momentum there. But the clue for me that we were going to come back up is that we fell down more correctively, okay, than we came up. Okay, you can see that that is more aggressive than that sell-off. Okay, so when it's noticeably more less aggressive, the sell-off, than the rally to the upside, which has preceded it, it's more likely that we come back up. So if I'm looking for a price to come back up, I'm asking myself, well, where is it coming up to? Because if there's a little area of value above, then it may be coming up to there. If there's not, I mean, there is a tiny one there, but I'm not sure how many people would have been paying attention to that so much, especially given that this high is visible on the monthly, whereas that other one I just showed you is not so much. Okay, so the likelihood was the price is just coming back up to fill the orders that are above here before the big sell-off to the downside. Okay, so what happens? We come back up. We have a bit of we have that kind of impulse correction continuation, but then we wick to the area and not through it. Okay, so we don't break above. As I said to you, just as on the flip side, we usually break below these these higher time frame liquidity points if we're going to rally to the upside. So it's also true. It's just alerts going off. There's lots of erratic price action at the minute. So is it. It's also true that we break above these higher time frame liquidity points, these attractive areas of value, if we're going to move to the downside. More often than not, nothing happens all of the time, and nothing happens none of the time. Okay, that's what you have to remember if you're going to think probabilistically in this game, and that's a vital ingredient to trading successfully. So as I said yesterday, We could have had, I mean, this was a bit of a steep one, but I'm also looking at that. At the time, I would have been looking at, we had a sharp move there, okay, and a 1, 2, 3 into it. It's possible that this could have been a reversal structure to come back up, okay, maybe to tap into some of these highs up here. But what happened? We completely smashed through. We completely smashed through that low, disrespecting it. And if we disrespect a low such as that and we correct underneath it, then it's more likely that this is just an impulse correction continuation to push lower. Why? To come down to here, which is a more attractive area of value than there. Okay. The bigger players are looking at what is the most attractive area of value for me to buy. And the one that stands out the most is that low and not that one. Okay. So just a little bit of simple business mechanics, if you like. So the other clue, we did have, as I said, we did have this kind of reversal structure here, which could have indicated that this was that was an attractive area of value for a buy, but there was a little clue in here, as I said yesterday, which would have told me that it probably wasn't, and that is the fact that we have the first drive, second drive, and potential third drive, but the middle section within it, okay, had a lot of volume. Look at the depth that volume has. Okay, so if we have depth like that, it is likely that we will follow through. Pardon the expression. Follow through to by about the same amount. Okay, so if that's the volume that's been generated, the breakout will likely be of a similar length. Where does the breakout stop? It stops there. Well, if it stops there, then we may not get the, if it breaks well and truly below like that, either we are breaking back in and it's just breaking further than we thought because of the volume that's been generated there, and then we push to the upside, or more likely when there's this much volume in a middle section, we will create a little hook point like that and then create a structure underneath, which ends up being the impulse correction continuation to push lower to take out that low down there. Okay, the base of all of this volume. Okay, and if we measure the impulse there, where that impulse started, we take it to the break. As I said yesterday, that lines up perfectly with there. So that makes contextual sense here. Okay, so notice, so the middle section within that structure was very big, as I just illustrated. However, notice that the middle section middle section within this structure. So this, let's try that again, shall we? That wasn't too clever. The middle section within this, so this doesn't have nearly as much volume, suggesting that this is the area of value, and that, you know, if this was a lot bigger like that, we could be blasting to the upside. But there's much less volume in the middle section. Okay, but prices pushed down. Prices pushed down again here. So what we may be getting, I'm just trying to, what we may get is something like this. Notice what have we done? We've near missed to this area, okay, and that area near missed there. So what we may get is a little internal 1, 2, 3 like that to push up to there, okay, because this isn't really the angle. If that we were to put a trend line there, that's not really the angle that we see if we're going to move to the downside. Okay, so what I'm looking at now is a potential little internal 1, 2, 3 that lines up with there. Okay, so I wouldn't be surprised if this happens, and if it does, this may not be ready by the end of the day once again, but we shall see. But regardless, what are we looking for? Is I'm not going to be looking to FOMO into trades here, even if you did get a little flag here. What would the risk to reward be? It would be difficult, especially with my commitments, to manage it to the low. I guess you could, but you know, there's near misses, multiple near misses there, and this just looks like a little internal structure to me that will likely do something like that. I bet if we drill down, I haven't actually done this, but yeah, I wouldn't be surprised if that happens. We come down and then we have that little structure like that, perhaps tap into there or there. Okay, because notice, look, we've near missed to that low there. Okay, so we've very likely come back up, come back down, tap into either that or that, then push to the upside. But we shall see. Regardless, what I'll be looking for, I'm not going to be taking any of these noisy trades in this area here where people are likely usually lose money. What I'll be looking for is, let's get that off the chart. Just checking the time because I have a webinar to attend, a trading webinar at 7 o'clock, and it is currently just gone 6:30. We're good for time. So I'll be looking for a tap into that area of value, which just so happens to be the retest of the back end of that previous low. We can't even see it now. So that makes it an even more attractive area of value. I'll be looking for a tap into that area of value, a push down, a 1 hour impulse down. Once we get a 1 hour impulse down, I'll be looking for one corrective candle on the 1 hour chart to close green. So the impulse down will be red. I'll be looking for the green corrective candle. Then that unlocks the door to me to the 15-minute chart, where I'll be looking for a minimum of 6 to 8 corrective 15-minute candles. And then if we get them, we have two bottoms to work with. I'll set an entry on the break, and then I'll be looking for price to push up and tap the initial high. And if that happens and we get a rejection from there, so a high test candle or a retrace candle, then I would set the an entry within the structure and cancel the original order on the break, whichever shapes up. If we don't tap that high, then I'll just let the original order trigger me in. Then I'll be able to manage it down to this low, most likely, depending on how it forms, for something in the region of 5.5% to 6%. And my target in this instance would be that the low of that, all of that volume there. Okay, and I would mechanically manage this. I would use the Fibonacci retracement. So the 90% area of a range is where price tends to pull back deeply, even if it is going to continue in our forecasted direction. So I would set a take profit there. I would trail my stop loss, and then we would likely have something in the region of around 12% to work with. Whether we capitalize, whether we catch all of that is another matter. There may be pullbacks that take us out of the trade in the meantime, but regardless, that's what I'll be looking for. And I hope you've enjoyed this video, folks. As I say, as stuff starts to shape up, I'll be able to bring you different pairs. But I'm not gonna FOMO into positions that aren't ready. Okay, so that's one of the key ingredients of trading. There's lots of people that have higher IQs than I do. I've got more qualifications and all the rest of it, but they're not. Their P&L is not as good as mine because they know how to get into trades because they're academically savvy, but they're not emotionally savvy enough to stay out of the shit trades. Okay, so that is one of the differences in these periods when price corrects. People that have made money, academics, non-academics alike, they start to FOMO in because they're like, well, nothing's shaping up. I'm just going to take this one. That's not what I do, okay? And that's not what professionals are doing, okay? If you're trading millions and millions of pounds, if you were trading for a bank, would you do that with people's money? Well, if you did, you wouldn't be in a job very long. I can assure you of that. So treat your trading and treat your trading account as if you were trading on behalf of a bank, okay? We don't know exactly how they trade, but treat it with the same level of respect and mitigate risk in the same way. Be patient in the same way that you would if you were trading for a bank, okay? As if you were trading somebody else's money, even if you're not already. You may already be doing so, but treat your trading account as if it's somebody else's money and watch your P&L change dramatically, okay? So thanks for watching, folks. I hope you've enjoyed this video. Let's try that again. Thanks for watching, folks. I hope you've enjoyed this video. As you can see, alerts going off everywhere. That's just a lot of volatility and fear and all the rest of it. But I'll see you again in the next video. Thanks for watching.